Hi, and welcome to this video. So I have printed some of the Cengage problems, and I'm going to work them on paper, and I suggest that you work them on paper as well, because sometimes working on paper gives us a different experience than working them in Cengage. So I want to show you that this is an option and how to go about it. So this is the first problem, and it tells us, what I always like to do is I like to look and see what is it asking. So it says, what is the amount of gross profit? So we can either use the textbook or our notes, and remember that gross profit is equal to sales minus cost of goods sold, and that's gross profit. So if we look at this problem, it says that during the current year, merchandise is sold for $186,500 cash. So this is sales. We would call those cash sales. And $1,437,200 on account. These are also sales, but they are accounts receivable sales, but both of these are sales. So we'll add up $186,500 plus $1,437,200, and those are our total sales. Then the cost of the goods sold is $900,000, so we'll subtract out that. So go ahead and get out your calculator and put that in and see what you get. $186,500 plus $1,437,200 minus $900. So I get that my gross profit is $723,700. So the answer is that. Okay, and I have included the PDF of this so that you can open it and print it, but you could also just go into Cengage and print the whole assignment and get it that way. All right, so let's go to the next page. So this is practicing our purchase transaction. So in the merchandising chapter, we're either purchasing, which means we're buying inventory, or we're selling, which means that we're selling inventory. So this one, we're buying inventory. It says Bowers Company purchased merchandise on account from Saunders Corp for $28,000. The terms are 110 net 30. All right, so let's just look at that part first. So we purchased merchandise. So merchandise, we'll use the account called inventory, and it was for $28,000. And it gives us some credit terms. We'll talk about that, but that means that they offered us a 1% discount if we paid within 10 days. Then we returned merchandise with an invoice amount of $5,500. So we didn't keep that whole $28,000. We returned some of it. So we returned $5,500. So we'll subtract that out to find out how much our net is that we kept. What's our net inventory that we kept? So you'll say $28,000 minus $5,500. So we kept $22,500. All right, if Bowers Company pays the invoice within the discount period, what is the amount of cash required for the payment? So $22,500 is the cost of our inventory. But if we pay within 10 days, that's our discount period, then we can take a 1% discount. And so we can either say $22,500 times 1% and subtract that. So that would look like this. 22,500 times 0.01. All right, and so when we do that, we get 225, and that's the discount. So that's the amount that we can subtract out. So then we'll subtract out 225, and then we can see that we have 22,500 minus 225. So that would be 22,275. So that's the answer. That's how much we would need to pay if we paid it within the discount period. So that's the amount of the inventory minus what we returned to them, and then with the discount. There is a faster way to do it. What you could do is say 22,500, and then if I don't need to pay 100%, instead I'm taking a discount of 1. So you can say 100% minus 1% is 99%. So I could just say 22,500 times 0.99. And when I do that, I'm going to get this exact same answer as I got before, just in a shorter way. So 22,500 times 0.99 is equal to 22,275. So that is the same answer. So I can either subtract out the 1% or just multiply by 0.99 and get the same answer. So what account is debited to record the return? Well, when we purchase inventory, we debit inventory and credit accounts payable. So whenever we return it, we reverse that. So when we return inventory, we debit accounts payable and credit inventory. So they say what account is debited when we record the return? Well, this is our return. What account do we debit? Accounts payable. So the answer here is accounts payable would be debited, because what we would be doing is reducing that, because we won't owe them as much because we returned some of it to them. All right, let's look at the next page. So here we need to talk about what we mean by shipping terms. So we have two shipping terms. We have FOB destination and FOB shipping point. FOB destination means that when you shipped the goods, the title to those goods changed hands at the destination. So that means that the whole time it was traveling, it still belonged to the seller. So for FOB destination, seller pays shipping. So for FOB shipping point, that means that the goods changed hands at the shipping point. So the whole time they were traveling, they already belonged to that person that was buying them. So for this one, the buyer pays shipping. All right, so they just want to know how much needs to be paid to settle these bills. So in letter A, we have merchandise invoice amount of $24,000. But then if we read across, we can see that we returned some. So let's subtract out that $2,000. All right, so then we're left with $22,000 as our net purchase. But we paid it within the discount period. So we paid it within 10 days, which means that we get to take a 1% discount. If we get to take a 1% discount, that means we're not going to pay 100% of the $22,000. We are only going to pay 99% of it. So $22,000 times 0.99 is how much we'll pay for that. And that is $21,780. Now the only other question is, do we need to add shipping to that? Well, we're the buyer. If it's FOB destination, does the buyer pay? No, the seller pays. So we're not going to add that. Now I know that this says freight paid by seller, but the seller might have paid it to UPS or FedEx, but they're not going to bill it to us. So we'll do nothing with that. Okay, it doesn't matter who initially pays it. What it matters is who ultimately pays it. What do the shipping terms tell? And here the seller paid it, and ultimately the seller's going to pay it. So we're not going to add it to the invoice because the buyer is not responsible for that. Let's compare that to letter B. So our invoice amount is $31,500, but we didn't keep all that. We sent back some of that inventory. And so we're going to reduce our inventory by the amount that we didn't keep. So $31,500 minus $2,500 is equal to $29,000. Here, they offered us a 2% discount if we paid within 10 days, and we did. So we're not going to pay 100%, we're going to pay 100 minus the 2% discount. So that's 98%, or 0.98. So 29,000 times 0.98 is 28,420. Let's look and see, do we need to add the freight to this one? Well, this is FOB shipping point, and the buyer pays. So we're the buyer, and we're trying to figure out how much we need to settle this invoice for. So yes, we add the shipping to this one. So 28,420 plus the shipping, because buyer pays for this one, is 28,670. Now, I know it says freight was paid by the seller, but they paid it, but then they're turning around and billing it to us because ultimately the buyer is responsible here per these shipping terms. So that's why we do add it here. All right, let's look at the next one. So we're still buying inventory. We still haven't sold anything. We're still buying stuff. So the stationery company purchased merchandise on account from a supplier for $14,500. Terms are 210 net 30. They return the merchandise in the amount of $3,500. So we're going to subtract out that So our net merchandise that we kept was $11,000, and they want to know what is the cash amount required for payment. Well, we paid it within the discount period, so we're going to take a 2% discount. So we don't pay 100% of $11,000. Instead, we're going to pay 98% of that. So if we say 11,000 times 98%, you can see that it is 10,780. So the amount that's required for payment of this invoice is $10,780. Under the perpetual inventory system, what account is credited to record the return? Well, when we buy inventory, we do inventory and accounts payable. That's when we get inventory, it goes up, and accounts payable goes up. If we return it, we just flip that around. So instead of crediting accounts payable, we debit it, and instead of debiting inventory, we credit it. So that means accounts payable goes down and inventory goes down. We just do the exact opposite from when we bought it. So this is saying what account is credited to record the return. Well, this is our return. What account do we credit? Inventory. So we credited inventory here. All right, let's go ahead and look at the next one. So for this one, they want the journal entries to purchase merchandise on account 110 net 30. We're going to initially put this down at the whole price. So if we purchased merchandise, we're going to call that our inventory. Some people call that merchandise inventory, but this book is just calling it inventory. And if we purchased it on account, our accounts payable will go up. So they tell us that we purchased it for $36,000, so I'll debit that and I'll credit my accounts payable. The next question, letter B, says, let's go ahead and pay the amount of the invoice within the discount period. Well, the first thing I need to do is get rid of whatever's in accounts payable. So look up at letter A. How much is sitting in accounts payable right now? A credit of $36,000. I want to get rid of that. So what will I do to accounts payable? If I want to get rid of a credit balance, I need to debit it for the whole amount. Then I need to go ahead and pay it. So I need to give them cash. Well, how much do I need to pay? I'm not going to pay 100% because they offered me a discount and I paid it within the discount period. So instead of 100%, I'm going to give them 100 minus 1%, which is 99%. So that's 36,000 times 0.99. 35,640. So I'm going to credit cash because my cash goes down when I pay it out for 35,640. So right now I'm not in balance, and I'm actually off by the amount of the discount. And the amount of the discount is going to lower my inventory because, you know, I thought I was going to be paying the whole thing for the inventory, but it turns out I didn't pay 1% of it. So I'm going to reduce inventory by that 1%. So I'm going to say 36,000 times 1%. This will be my discount amount. So 36,000 times 1% should just be 360. And I'm going to reduce inventory. Inventory is an asset. Assets have a normal balance of a debit. So to reduce it, I need to credit it for 360. And by doing that, now I'm in balance. My total debits equal 36,000. My total credits together equal 36,000. So that's my entry. All right, letter C says, discovered that merchandise with an invoice of $9,000 was defective, and so I returned it. It was after I had paid for it, but I went ahead and returned it because it was defective. All right, so when I return inventory, I'm going to mail it back to them. So I'm going to reduce my inventory. Inventory goes down with a credit. And then they didn't give me money back, they gave me credit. So my accounts payable will go down with a debit. Because I've already taken the discount, I'm not going to get a credit for the whole thing. It'll only be 99% of this. So 9,000 times 0.99 means that I'm only going to get a credit of the amount net of the discount. So that's $89.10, $89.10. So at this point, because I was already completely paid off, my accounts payable actually has a debit balance, which is negative. That just means I'm overpaid. They actually owe me money at this point. That's okay. I'm fixing to buy some more from them, and then they're going to refund me everything in a minute. Purchased $5,000 of merchandise on account. They didn't offer me a discount. It's just net is due in 30 days. So I got inventory. Inventory is an asset. It goes up with a debit. I bought it on account. I'm going to owe them, so that's accounts payable, $5,000. Now it says I received a refund for everything that I've done so far, less the for the return, less the purchase. So let's just see what's happened in accounts payable. If I look in accounts payable, I can see everything that's owed to me. So I'm going to scroll up. Here's what I did accounts payable. I credited it for $36,000. Then I debited it for $36,000. So that got me down to zero. Then I debited it for $89.10 for that return. And then I credited it for $5,000. All right, so let's put all that in. I think that was $36,000. Yeah, it was. Here's what's happened so far. I bought something on account. I paid it off in total. Then they gave me a credit to my account, and then I bought some more on account. So if I add up my debits, on my debit side right now, let's just see what's in accounts payable right now. I have $36,000 plus $89.10. Right now I have $44,910 on the debit side. On the credit side I have $36,000 plus $5,000. So on the credit side right now I've got $41,000. So I subtract and I put it on the side that's the biggest. So which side's the biggest? Is the debit side bigger or is the credit side bigger? The debit side's bigger. So right now my balance is $44,910 minus $41,000, $39.10. So what this means is that I don't owe them. This is a debit balance to a liability, which is the opposite of its normal balance. They owe me $39.10, and they're going to give that to me in a refund. So they're going to give me cash of $39.10, and once and for all, I'll put this to accounts payable, which will zero it back out. And now I don't owe them and they don't owe me. So I'm going to stop this video. I will continue with the remainder in a separate video. But if you made it through this part, very good. And let me know if you have any questions. Thanks.